the Canadian banks have been paying dividends since the late 1800s, uninterrupted dividends. Now they haven't raised every single year, but they haven't stopped paying. So I'm not too concerned with them suspending dividends, for example, or they didn't cut any dividends. At least the big fives didn't cut dividends during the financial crisis. So
One, 2, 3, 4.
All opinions expressed by Chris, Michael, and Ryan are solely their own opinions and do not reflect the opinions of 5i Research or i2 iCapital Management. This podcast is for informational purposes only and should not be relied upon for any investment decisions. Employees of 5i Research may hold positions in the securities discussed in this podcast.
Welcome to the 17th episode of The Exponent with 5i Research. My name is Chris. I'm the head of research with 5i, and I want to welcome you, our listeners, to our journey into the heart of the Canadian markets. Our mission is to empower investors with precise insights and in-depth research into stocks, the economy, and more. With that said, let's dive into the Canadian and U.S. financial landscape. So today we have a very special episode for our members. I'm joined, as always, by my co-host, Michael. And together we're thrilled to welcome Bob Lai, the creator of Tawcan.com. It's a blog chronicling his journey toward financial independence while maintaining a balanced and joyful life. So through his blog and recently launched podcast, DIY Wealth Canada, Bob shares insights into his dividend investing strategy, his views on the market, and how he approaches building long-term wealth through dividend stocks. It's going to be a great conversation filled with practical takeaways and personal wisdom. I'm personally really excited for this one. So Bob, with that said, welcome to the show.
Yeah, thanks for having me. It's always good to talk about personal finance and investing and, of course, FIRE.
Yeah, definitely. And it's great to have you on and great to have a Canadian voice that wants to talk about the markets, that's interested in, all things stocks, dividend stocks, growth stocks, everything. And so you have a blog online, Tawcan.com, where you discuss your financial investing journey, your dividend portfolio, and you also recently launched a podcast with Nelson Smith from Canadian Dividend Investing. So I want to get into a little bit about your personal backstory. For those unaware, in your blog post, you talk about a financial epiphany that you had in 2011. And now your dividends exceed, $5,500 a month. Can you walk me through that evolution and kind of what that epiphany looked like in your mind?
Sure. So it kind of started back in, I guess, 2010-ish, like 2010. I met my wife. Actually, we met earlier, but we were dating and didn't really talk too much about money at all. And then a friend of hers gave her a book called The Secret of Millionaire Mind. And that kind of got us started in terms of talking about money, learning a little bit more about personal finance, investing, et cetera. And that just kind of gave us a roadmap towards the whole FIRE movement. Back then, FIRE wasn't really a thing. It was just about saving and investing. And we started learning more and more. And that's, I think, around 2011, that's when we got really serious in terms of doing our own investing portfolio. I was doing a bit of DIY investing through our university, but honestly, I didn't really know what I was doing. And like a lot of Canadians, I was utilizing a lot of mutual funds, like high NER mutual funds. Right. Yeah. And then my wife is originally from Denmark, so she didn't really know much about the Canadian investing landscape. So it was kind of an interesting mix where we could kind of learn together and discuss together. Right. So we started our, I call it financial epiphany in 2011. And then I think in 2014, like from 11 to 2014, I was reading a lot of blogs, a lot of finance books, and started reading about the financial independence retire early movement. I guess that back then it was really like Mr. Money Mustache and a few others, right? And then there was a desire to start a blog, and I have started a few blogs back in my university days, like personal blogs, and I realized it was a lot of work. So I kind of rolled ahead and had a few posts lined out, and then decided just to start and kind of jump into them. And that's how the blog got started. And it's been 11 years. It's been a lot of work, but it's also very rewarding.
Right. Right.
Managed to connect with a lot of other bloggers around the world, both Canadian, US, some Europeans as well, and met a lot of readers, a lot of bloggers in person. And just kind of evolved throughout time. And then I guess in this summer, we're recording in October. So I think in the summer, Nelson was kind of tweeting, "Hey, anybody wants to start a podcast? Let me know." And I was like, "We should talk." And we kind of hashed out a really quick business plan and podcast plan, and we're like, "Oh, let's do it and see what happens." So we've been recording episodes here and there and just see where that goes. So it's just another side project. So yeah, that's where we are. And we started off, like I said, mostly dividend investing, and then over time we added index ETFs as well, just trying to be more diversified. And I think we're at $5,500 a month or something. I think this year we're going to getting about like $64,000 in dividends, about like 12 guys, right? And so we're getting pretty close. It's getting a pretty sizable investment portfolio. So it's kind of interesting. I'm more now writing more about the whole retirement planning, like how to pull the trigger, what our mentality is. So it's been a really interesting ride. And the nice thing about the blogging world is there are people ahead of us and people behind us. So there's a lot of support. So it's always nice to talk to people ahead of us and get some ideas, both on Canadian side and US side, and then kind of, give back to the community and helping other people kind of a few years behind us too.
Yeah, no, definitely. It's great to be, getting challenged by those that are further along in the journey and, helping those behind you. And I also, I heard you once say, just kind of off of that, similar to that topic, that, your ego is not your amigo. So once, I think you were mentioning how much your portfolio had grown or how much you were receiving in dividends. And it sounded like you had mentioned that you were receiving some comments from some people in regards to that, feeling that they thought it was braggadocious, I suppose. But you kind of mentioned, that's not exactly what I'm trying to do here. I'm really just trying to, chronicle my journey and explain, how, and I love the transparency personally. Like, I really love that transparency, and I don't view it as being, egotistic or anything like that. And so it's really great to be, fully transparent with that, receiving the dividends and sharing your journey towards, retiring early. So that's awesome. And it's also really interesting, like the timeline when you started too, around that 2011 to 2014 period, because, the US had just gone through the great financial crisis, and stocks were, nearing back to those all-time highs around like 2011, 2012. But there was a lot of fears of like, maybe it's a double top or something, and, it's going to crash again. And there was a lot of like investor fear. And so that would have been a really interesting time to start learning and kind of getting, your feet wet, so to speak, in the investing landscape, and learning about mutual funds and all that. Just kind of everyone has those first 3 years when they start investing that they really just need to figure everything out and kind of, cement their own personal style.
For sure. And I think there's so many different products now available compared to 2011. Even I was kind of investing 2009, 2010. We could talk about my investment mistakes. Like, got lots to share. But that was interesting time, right? So, but yeah, like with the different ETFs available now, it just gives Canadian so much more choices. So it's really a great time to invest right now.
Yeah, I agree. And kind of, off of on that same topic of ETFs and index investing. So you kind of mentioned that started kind of working into this hybrid strategy where, you're investing in dividend stocks, but also, working in some index ETFs for a bit of a growth tilt. So can you talk a little bit about like how and when did you decide to move from, pure dividends to this dividend plus index ETF hybrid approach? And also, I think you've talked about total returns as well, and just kind of how you have to factor in total returns as well when looking at dividend stocks and a portfolio. So if you can kind of share your thoughts on that.
Sure, kind of need to go back in time a little bit. So when I started working full time, I bought the very first stock. Well, during working, right? So during university, I bought some individual stocks, but I didn't really know what I was doing. So the very first stock I bought once I started working full time was a company called ING Direct. And back then I didn't really do any research. I knew there's an ING Direct as a bank, so I mistakenly thought, hey, that's the stock. But turns out that was the insurance arm, right? And eventually that became what's known today as Intact Financial.
Mm-hmm.
So I bought that stock just before financial crisis.
Oh wow!
100 shares of that stock, and then it tanked like brick during financial crisis. But the reason I went into it was because the stock was paying a little bit of dividends. I didn't really know much about dividends. I just thought, hey, that seems like a good stock to buy. It's in the Canadian finance sector. And when it tanked during the financial crisis, I was like, well, I could sell and take my losses then, or I could just keep investing and let the kind of collect dividends and then see if it recovers. So that's what I did. I didn't sell. And I think Intact Financial today is, I can't remember the price, it's over $200. So it's multi-bagers for us. And then the second stock I purchased was Manulife. And that was before they cut the dividends during the financial crisis. Again, it went down a lot, but
right.
Again, I had the mentality of, hey, if I sell those stocks and put them into GIC, I would be getting even worse yield. So I'll just leave them. And when I was young, so I didn't know any better, so I didn't need the money. So that was one lesson I learned is don't invest with money that you need in the short term, right? If you could invest with money you don't need in the short term, you could write it out, right? You could write out the volatility. And then, financial crisis kind of recover, and then we had our financial epiphany per se, and we started adding more and more dividend stocks, and through that, make the typical mistake of focusing on high yield stocks and got burned a few times there. And eventually we started looking into the U.S. market. We bought like big U.S. names, right? Like Apple, Coca-Cola, McDonald's, Procter & Gamble, Visa, etc. But then when I started looking into the U.S. market, I realized I couldn't own everything. And then that's just the U.S. market. There's such a big market outside the U.S. and Canada, right? There's like Japan, China, the European market. So that's when we started looking into index fund. So at first we bought the Vanguard X Canada index, so VXC. Reason we went with Vanguard is a big name, and but back then Vanguard was structured such that the MER was a little bit higher than XAW, which is the iShares version. So after holding it for, I think, less than a year, we decided to switch over to XAW rather than VXC. And XW back then had a little bit more exposure to the US market compared to VXC. That's one of the reasons we switched over to XAW.
Okay. Yeah.
But since then, I think VXC and XAW have the same MER. nowadays, and they're very close. So I think going with
very
either one
competitive.
is fine. Yeah, and we just thought we wanted to be able to diversify, right? The nice thing with dividend stocks, you get a dividend income, but you're handpicking a few handful of stocks. You're missing some growth stocks, for example.
Yeah.
Right.
Yeah,
And then I think earlier this year, last year, we started getting into NASDAQ. So we invested in the Invesco NASDAQ 100 index, the QQQ, and we switched over to QQQM because that one has a little bit lower NER. So those are the two index ETFs that we hold, just trying to kind of give us a little bit more diversification. So that's kind of the reason behind that. And
Nice.
then also I work in high tech, so have a little bit of company shares, or kind of trying to not to be
Natural
overexposed
exposure.
in tech sector. But having said that, I when I write on my blog, I talk about the dividend side and the index side, but we also have a very small percentage of our overall portfolio that we invest in, like the higher volatile tech stocks, like I guess not exactly high volatile nowadays, like the Amazon, the Tesla, the Nvidia, Meta I sold too early, but you never know. So
that's a wild ride.
We try to keep the exposure to less than 10% of our portfolio. Anyways, it's kind of limiting our risk, right? So if everything goes to zero, we are not screwed, kind of thing. So that's the idea.
Yeah, it's 10% in a absolute worst case scenario. If that goes to zero, it's the equivalent of about 1 year's worth of returns potentially, or maybe one and a bit. That's really, I really like that approach. And I think it's unique. I've heard a lot about dividend investing and pure play dividend investing, but that hybrid approach I think is really unique and works well, because investors, when the index ETFs are performing well, and most of the S&P 500 is really dominated by tech stocks and the Magnificent Seven. So when those growth kind of sectors are outperforming, and there's a potential that the dividend names are kind of lagging at that point, there's a potential to rebalance and reweight a portfolio and add to those dividend names, and then vice versa. When say for example 2022, when the market drew down massively and NASDAQ 100 and S&P 500 drew down 30+%, it's a good opportunity to kind of add to that index ETF and rebalance out of the dividend stock. So I really like it for that approach, and especially I think it helps to get that growth tilt, and that can kind of help with the whole financial independence, retire early kind of movement, because it kind of like acts as an accelerator. It's like an accelerant. So it's a really good method. I like that a lot. And then Michael, I think you wanted to talk about stocks here.
Yeah. So it's almost like 20 minutes in, and I didn't add anything yet. But so Bob, like, nice story so far. So I'm just like curious. So you've been through the global financial crisis and also COVID. Is there any dividend names in your portfolio that announced a dividend cut during those periods? And how did you handle like the stress or the drawdown?
Absolutely. Let me think. So some names jump in my mind would be like Manulife. I mentioned they cut dividends during the financial crisis. I think Intel cut dividends a few years ago, but then by then we exited Intel already. Inter Pipeline, we got burned on that one. They cut dividend. Bell, which we still hold, earlier this year cut dividends. Eloquan, AQN, that's a good one, also cut dividend. The way we structure our portfolio, we try to have each individual stock less than 5% of our overall portfolio. So even if there's a dividend cut, it's not like detrimental to our dividend income. Let's put it that way. Now, having said that, if I look at our portfolio today, I think we own, I'll admit it, we probably own a little bit too many. I think we're at 38 individual stocks and 2 index funds. We would like to get it down to about 30, 35. And if you look at our current individual stocks plus index ETFs, there are a few names that are over 5%, you know, the likes of like TD, Royal Bank, mostly Canadian banks, Apple being one of them as well. But I'm not as worried in terms of these making more than 5% of our portfolio because the Canadian banks have been paying dividends since the late 1800s, uninterrupted dividends. Now they haven't raised every single year, but they haven't stopped paying. So I'm not too concerned with them suspending dividends, for example, or they didn't cut any dividends, at least the big fives didn't cut dividends during the financial crisis. So they're pretty solid. So we definitely have gone through dividend cuts here and there. I know some dividend investors, they sell out whenever they see a dividend cut. We're kind of on the other side. We don't just immediately sell if it makes sense. Like, for example, Bell, right? Like they were in so much debt. It makes a lot of sense to clean up their books by cutting dividends. Right? In that sense, I totally make sense. Now, couple example would be like Suncor and I think H&R REITs. H&R REITs, I think it was, during, or maybe not H&R REITs, RioCan was the one. They also cut dividends during COVID, but for a long time, the CEO was saying, we're not cutting dividends, dividends are safe. And when they cut it, I was like, well, I can't trust the management team anymore. So that's kind of a little bit different than BCE. So I kind of evaluate a little bit and then see if it makes sense to close out the position and move on or not. So that's kind of what we consider.
Gotcha. And also it seems like a lot of your stocks fit the definition of like value names, like Intel, the Apple, Manulife, on those stocks. And so I'm just wondering, like, so at 5i we usually stocks like there's cheap stocks in the market, but also stocks that are cheap for a reason. So what are some of the red flags that you usually look for in the stocks that you choose to stay away from, like the value trap?
Yeah, for sure. That's unfortunately your April is never really clear. It's always fuzzy. So you kind of take in some calculated bets, right? So one example I would say would be TD. Right, during COVID, I think it dropped to, well, I guess everything dropped during COVID, so that wasn't a good example. But recently they had a scandal, like kind of money laundering scandal in the US, and they were getting penalized. And the stock just tanked significantly. And I looked at it and thought this might be a short-term opportunity, right? Like, sure, they're getting a big penalty, but if they clean the house, get rid of the CEO, get rid of the board, and bring new people over and really review their internal staff, the stock price probably will recover. But I wasn't expecting it to recover so quickly. So we were buying a lot of TDs in like the $70, $80 range. And now I think TD is over $100, right? So that kind of stuff, we're trying to take opportunity. Now, in the sense of Bell, like it's been kind of, Bell and Telus, it's been pretty flat and down the last few years. Now, they do pay a lot of dividends, so we still own both Bell and Telus, but we're not actively adding more shares. If we add any more shares, it's through drips. Right, so that's kind of potentially a value trap per se, but we kind of still own them for the dividend income side of things. Now, if you look at the Canadian National Railway, it has done really poorly this year, just because of the tariffs. But I kind of see that as an opportunity, right? Like, I can guarantee CNR will be around way longer than the current president in the US, right? His term is only 4 years. So CNR is going to outlive the political landscapes of the US, like current political landscape. So that's perhaps a good opportunity to buy. Sure, you're not going to outperform the market or even perform the same as the market, but if you're okay with taking short-term pain, maybe in the long term it's okay, right? So you kind of have to almost look at it from a macro point of view, look at it from a high level, instead of, because I find a lot of the analysts only look at short term. It's like, oh, this is good buy, this is bad buy, but they're not looking at it from a long-term view. Like if you're investing for 5, 10, 15, 20 years, right? Like this past Friday, the whole rare metals tension between China and US, and the market went down by, I think, 3% around that.
Mhm.
Everybody was freaking out. And if you step back, I think year to date, like the S&P, TSX, NASDAQ were up, I want to say over 15% year to date, right? So like a 3%, it's really considered a blip. And yet everybody is freaking out about it. And for me, we actually transferred some money and bought some Brookfield Corporation, because we thought, hey, that's the stock was down, I think 4 or 5%. So we're like, hey, that might be a good opportunity. Even if the market continues to go down, we could dollar cost average down. So you kind of have to take calculated risk here and there, limit your exposure, right, and go from there. I think if you invest in a company that has good fundamentals, good valuation, I think long term typically it does really well. And the reason we like dividend investing is that you could kind of, the way I think is like hedging our consumption, right? So I look for companies that produce products that people use on a daily basis. And the harder it is for them to switch, the better, right? So, I talk about TELUS and Bell. Why are we still investing in those two companies? Because what's one of the things Canadians complain? High cell phone bills, right? So, people don't really switch. Well, people switch their cell phone companies and their internet providers, but people are always complaining. So, why not tap into that? And then banks, right? Canadian banks, how many people do you know switch their banks regularly? Probably not that many, because it's painfully rare and to have to switch your financial institution. So typically people, I bank with TD. It's only because my parents bank with TD, right? So a lot of these generation effects with Canadian banks, right? And then I mentioned Apple earlier. Why do we invest in Apple, even though people say, hey, there's no more innovation, etc.? Well, if you look at Apple, a lot of people I know switch from Apple to Android and they come back to Apple because of the ecosystem. But Apple is no longer just about their hardware. It's all about the ecosystem. Like you can see they have been integrating their operating systems across the different platforms, where if you're on your phone, it's synced to your Mac, where if you're on the website, you can seamlessly transfer your browser histories, and then there's essentially no gap, right? So this kind of ecosystem ties the users in. So for them, it's harder and harder to switch out of the Apple ecosystem. So this kind of stuff we look for, and we keep our ears open to hear like what's going on, right? So that's kind of the idea.
Very nice. Yeah, and also you mentioned about CNR. Probably that company is gonna outpass like most of us a lifetime.
Yeah.
It's out for like decades, and that will not go anywhere anytime soon. So I'm just like curious. Do you have a list of stocks, like around 3 to 5 names of high conviction names that you consider like never sell kind of holdings?
Yeah, for sure. I think the Canadian banks, right, the big five, I guess big six, including National Bank. Names like Visa is probably never sell for me. BlackRock, which is the parent company behind iShares. We started investing in Brookfield, like corporation, and Brookfield Asset Management. I think that's kind of the equivalent, the Canadian equivalent of Berkshire Hathaway a little bit. So and that's never sell. I don't know, company like Enbridge, like even though we're trying to move away from natural gas and crude, that's not going away anytime soon. Canadian National Railway, if you look at the North America, the way we transport goods and goods, especially railways, play a huge. It's very important, right? It's very costly to transport goods via airplanes in North America. So rails are still used quite a bit. And insurance companies, everybody buys insurance, so they're not going away anytime soon. So again, it really boils down to companies that you use their products on a daily basis, right? And I kind of, Costco is another name we like, even though they've been kind of going down a little bit the last few months. But every time I go to a Costco warehouse, it's packed, right? That's like one experience I don't enjoy. I'm a shareholder. It's like the parking lot is always packed, takes forever to park. And then once you go in, it's chaotic inside the warehouse. And, you buy a few things, next thing you know, you're coming out with a $400 bill or even more.
Yeah.
And it's like, what did I buy? And yeah, we keep going back, right? So when you step back and think about our business model, is that, well, people don't enjoy shopping in Costco usually, yet people keep coming back. So there's an attraction there, and that's why it makes a lot of sense to be a shareholder. So I like to look at things on a simplistic level. Sure, you still need to learn how to read quarterly reports and annual reports, but for me, maybe not like every quarter. You maybe like take a quick look at the annual report, just make sure the company's still making good money and profitable, kind of thing, right? Like that's where I think the analysts are doing a good job in terms of trying to make money short term. But if you're a long-term investor, you need to kind of step back a little bit and just look at more from a long-term picture. And another thing I've learned over the years is people talk about, and this might be a little bit controversial, is people talk about beating the market, and the whole idea of index fund is you're tracking the market minus the fees. So you're kind of just tracking the market regardless how the market's doing. And obviously there's always people trying to beat the market. But recently I came across a few books where they're talking about, it's not really about, sure, your performance, your portfolio is important, but it's not really about beating market or tracking market, whatever. It's really about how you achieve your financial goals. Like as long as you can achieve your financial goals, who cares if you're beating the market or you're tracking market or underperforming market, right? Like ultimately it's your goals. What are you trying to achieve? Are you trying to retire before you're 65? And are you trying to, pass down money to the next generations? Or are you trying to retire early? Like, and also it's like, are you trying to have a like lavish retirement? Right. So all these things obviously look different person to person. So that's where it's interesting, because personal finance is personal.
Yeah.
Yep.
Yeah, it's true. Yeah, personal finance is truly personal. So yeah, I'm curious. Like you mentioned, like your style of picking names seems like you target predictable companies, like basically subscription-based businesses and consumables. Basically, like things that people consume every single day. So I'm just curious. I did not hear you mention about software names. So thinking about like SaaS businesses, like subscription as a business model. It is also highly recurring, high margins, pricing power, on those stuff. What's your opinion on it?
Yeah, I think I think that's one thing I hate as a user nowadays is everything is subscription based. You look at Adobe for one, you used to be able to buy, Lightroom and Photoshop as a one-time payment. Now they went to subscription based. Even Microsoft, right? They went to subscription based. And we own Google or Alphabet. That's probably I personally view is that's the best company in terms of giving you free stuff and then kind of reel you in to get these subscription based, right? Like when they first came out with Pixel, they gave you unlimited storage for photos, and then Gmail was I think 15 gig or 17 gig, and then they kind of sucked people in with their Pixel phones, and then a few years later they're like, oh, we're not giving you unlimited anymore, and what happens? A lot of people are so used to taking lots of pictures, backing up on Google Photos. All of a sudden, everybody or a lot of people are paying these monthly fees to get more storage. And the thing is, if you're overly storage and you don't pay, you can't use your Gmail anymore, or like nothing works. Right? So you're kind of, once you're over that limit, you're kind of like restricted. You have to pay. Right, sure, it's $2, $3. There isn't that much per month, but how many users does Google have? Right, there's tons. So that's a very good revenue generators. You look at Apple as well; they have their similarly, right? Their cloud, right? Like I think SaaS businesses are great that way. So that's definitely one area to explore as well.
Mm-hmm. Mm-hmm. Yeah, sure. Also, one more thing, like you mentioned about TELUS. Are you a shareholder of TELUS here?
Yeah, we're still shareholder of TELUS. Yeah.
Yeah, nice. So I'm just like curious, how did you balance between like dividend yield and dividend growth over time? Like which one you like prioritize? Because like TELUS has been a solid like dividend yield name for most investors, but like the growth is not that impressive. So how did you think of it?
Yeah, I think ultimately it's not just about dividend income. I think Chris mentioned about total return, right? We do focus on total return. Maybe earlier in our investing career, we focus more on dividend income. But again, it's kind of a personal choice. I think you need to look at how your portfolio is made up. You need kind of a mix of low yield, high dividend growth or high total return companies, and also some high yield, low growth or low dividend growth companies. And what that mix is a 50-50, 60-40, whatever the mix is really a personal decision, right? Like if you're sort of closer toward your retirement, you need that income, then maybe you lean more toward the higher yield side. Now, if your retirement horizon is 20, 30 years, maybe you lean more toward that low yield, high growth, or even play more of the high growth, no dividend paying stocks, right? So again, that really depends. And we obviously have TELUS shares, pays a lot of dividends, and growth is slow, right? So I think over the last few years, we've been slowly shifting more towards lower dividend yield stocks, but higher dividend growth or overall return. And again, the number keeps changing, right? It could be that we're trying to hit a dividend income target this year, therefore we kind of lean more toward the high yield stuff. But over time, I've learned it's kind of dangerous to set a dividend income target for the year, because in a sense, you're kind of forcing yourself to, unless you have a lot of new capital to contribute to your investment portfolio, you're kind of sort of subconsciously telling yourself you have to buy high dividend yield stocks. And that's what we did a few years ago with Interpipeline, because we were like, okay, we want to hit this number this year. And when I look at all the stocks that we were selecting, it was like naturally we kind of leaned toward Interpipeline because the dividend yield was so much higher than the other stocks. So you kind of have to be a little bit careful when you set up goals and stuff. Sure, we set up goals, but I think if you look at our annual dividend income goal, the growth has kind of slowed down a little bit. Just we're trying to be a little bit more conscious about this issue.
Yeah, definitely. Yeah, and it's always a challenge when you go out into higher yielding stocks, because sometimes that's what we like to refer to as the market's way of signaling that a cut is likely, or maybe the company's more mature, growth is slowing. Whereas some people, some investors may just rush to a high yield thinking, oh, if I can get 10% plus the capital appreciates, I can get 10 plus a year. But really, in reality, sometimes we see the share price decline and the yield can stay at 10%. And the net effect is an annual return of less than 10. But I guess we've kind of talked about a lot of different stocks in various different industries and sectors, across like communications, tech, financials. If you had to say that you had a few top favorite sectors, a lot of dividend names are kind of in like the utilities, energy, staples, REITs kind of sectors. Could you kind of like choose and evaluate which ones are your top favorites?
I think over time we've been slowly moving away from REITs. One thing I learned from COVID is office REITs are unstable. I think that's maybe slightly going away, stopping now, because companies are forcing people to go back to the offices. In terms of REITs, I do like industrial REITs, right? The Granite, especially because with online shopping, you need to have some sort of warehouse to store these merchandise and then allowing them to ship to your homes quickly. And then industrial-wise, like we talked about Canadian National Railway. I like the garbage sector, so we own both waste management and waste collections. I think I've written about this a few times on my blog, where we talk about there are certain things in life, right? Like it's like death and taxes. But another thing that's pretty certain is we're going to make garbage, and if you make garbage, how do you get rid of it? You need some service to get rid of the garbage. So waste management and waste collections, I do like a lot because they provide us service and they charge you money for it. And and we did go into I think potash a while ago, thinking, hey, with the population getting larger, larger number, the potash, like the fertilizer business should be booming, but I just can't really predict what's going on. And with the mergers and everything, we decided not to get into that. There stuff that's kind of cyclical and it's a little bit harder to predict, so we try to stay away from those. Again, like something that, like I have kids now, right? So I kind of like the idea, if I can't explain my investment thesis to my kids, I try to avoid investing in these companies.
That's right. Yeah.
Because if it's so complicated and you can't explain their revenue model and such, that's probably a sign you shouldn't invest into them.
That's right. There's the common saying that if you can't explain something to a 5-year-old, you don't really truly know much about the subject or about the context. So, I really I like that. And then I think we're going to kind of shift gears a little bit from more of the specific stock and sector kind of focus, and kind of talk about, general like life, happiness, money. These are things that you kind of talk about and you try to balance. In a lot of your podcasts and blogs, you've mentioned, that you lived a frugal life, and that was kind of one key element to trying to save as much and invest as much and try to meet that FIRE goal. So how do you balance, kind of a joyful life with constraints like frugality or market stress, when the market declines like it did in April or through COVID, as well as, family responsibilities?
Yeah, where to start? So I think we have gone through a bit of progression. So I'll fully admit that when we started our financial independence journey, I was looking to cut everything, right? So try to be as cheap as possible, extreme frugality. Well, never got into the extreme side. My wife was pretty good with balancing things, but I was always thinking, hey, how can we save money? So about like, the latte factor, about we shouldn't go out for coffee or, have a nice pastry out or just eat in, and even groceries, like, oh, we shouldn't buy these, expensive groceries, right? Like find deals and stuff. Sure, that was fine, but over time I realized we can't deprive ourselves. If you end up depriving yourself and you have a not fun lifestyle, you're going to regret it, and you're not going to be able to sustain this FI journey. The journey takes a long time, like 10 plus years, like typically, right? I mean, you've seen people that retire after 5 years, and I think those are the extreme cases. So you're talking about 10, 15, 20, 30 years of like journey. And if you're not enjoying your journey, you're going to hate it. You're going to flip, right? So that's one. And two is, I write about the savings gap, right? So what do I mean is really your savings rate. So it's your income and your expenses. So if you could increase your savings gap, that means you have more money to put into your investment portfolio. Now, when people start the FI journey, like us, the first thing to do is cut your expenses. That's really, really easy to do. But you can only cut your expenses so much before you start depriving yourselves. Now, the other side is, how do you increase your income? That's really something that not too many people talk about. Like, if you're working, how can you negotiate with your employer to get more pay, like higher pay? And one thing I've learned is your employer will always try to pay you as little as possible. It's your job to negotiate and try to get a fair compensation. Now, your idea of fair compensation is always different than your employer's, right? And then one thing is, you need to kind of ask for a raise strategically. So there are many ways to do that, and I'm sure you could Google these strategies, but I've done that, right? I ask for raises here and there after accomplishing something at work, or with glass doors and those online salary lookup websites available nowadays. It's kind of easy to understand where you're at in comparison to your peers, right? So if you're kind of on the average and you've been really good performance, you're kind of pushed toward, hey, I should be on the top percentile of this pay scale. Now, if you're below the average and you've been kind of doing well, then you could kind of push that a little bit as well, right? So that's number one. So income is definitely something you could increase through negotiating with your employer, and then there's side hustle as well, right? You could sell stuff, or you make money through your hobbies. That will help as well. And so that's that. And it's really about finding the balance. And over time, I think another thing I learned is there's always going to be some level of inefficiency. Doesn't matter
Yes.
how hard you try, there's always going to be some level of inefficiency.
There's always a leak in the boat, right? Yeah.
Yeah, and you just need to be okay with it. Like 10 years ago, I would probably go drive for 10, 15 minutes to save like 5 cents per liter of gas. But nowadays I don't really bother because it's not worth my time. Right.
Yeah.
So you need to find that balance. And it's also like, is it worth it to, spend an hour, 2 hours trying to find deals and price match on every single grocery item?
Mm-hmm.
Yes, maybe that's the case for some people. For us, maybe not. What we do is we know there are things that we buy regularly, so we kind of keep an eye on the items. Like, for example, we drink barista oat milk, and I know barista oat milk price is say, I don't know, $6 per carton. And if I find, like, recently Linden Drugs had a special and we're selling for like $4.50 or something, and then I'm like, okay, I'll go out there and go out.
Right.
So I went and bought like 20 cartons. Right.
Oh wow.
And that's where we know we're going to consume it, and it makes sense to take opportunity of that and just stock up. But for me, it's no longer worthwhile to look up the flyers and then try to price match and have to spend like 30 minutes at the cashier and try to price match everything. But again, that could be the case for someone who's sort of early on their FI journey, right? So that's where you kind of have to make a judgment. And ultimately, I think the fundamental is still true, where you want to make sure you could increase your income, kind of keep track of your expenses, and really grow that savings gap, right? And it doesn't mean you should grow every single year. There's going to be some years you're going to spend more money, some years you're going to spend less. But you should know roughly your expenses, right? I think we've been tracking our expenses. It's not really a budget system; it's more a tracker. We've been tracking since I think 2010, so I could tell you like roughly how much we spend on groceries each year, and like, sure, it has increased over time, but we kind of know roughly how much we spend, or how much we're spending eating out, right? And if there's like a big jump, then we kind of, like, my wife and I, we've been getting in the habit of reviewing our expenses every 6 months and just like, hey, like, oh, that's odd. We're spending a lot more in, I don't know, eating out. What's going on? It's like, oh, wait, we have visitors, a couple months ago, and we took them out for food, and it's like, okay, that's not a big deal, right? But if there's something that you can't explain, you kind of have to kind of look into it a little bit deeper. The key, I think, is just understanding trends and then being able to cut back and so on, right? And also one thing I learned is spend money on things you enjoy. Like we used to enjoy dining out, but nowadays we actually like cooking at home better. So we've been cutting back dining out, but maybe get better ingredients when we cook at home, right? We like traveling, so we spend money on traveling. Now we don't enjoy spending money on internet services and cell phone providers. So I've been getting to the habit of calling them every so often and try to negotiate the deal. Right? So little things. So if you value eating out and you like going to fancy restaurants, that's totally fine. But maybe you cut back on groceries or something else. Right? So it's all about finding that personal balance and really don't spend more than you earn, and just kind of watch out for your expenses overall, and make sure you could regularly put money towards your retirement. I think that's the key.
Nice.
Yeah, nice story. So Bob, like one last question. So if like new investors, after hearing your inspirational story today, they want to ask something like how can they start building a dividend portfolio like you did like a few years ago? So what advice would you give them, and what you would like prioritize or avoid in today's market?
I think I would caution people jumping in overly excited, right? And then, as I mentioned, with the number of investment products out there today, I wouldn't necessarily recommend people starting with dividend investing today. I would probably advise them starting with an OE1 ETF. So like one of the Vanguards or iShares or Horizon, BMO. They all have like the all equities or the growth or balance. Pick one and build up a sizable portfolio with one of those products. So maybe like a XEQT, which is iShares or equities ETF. So maybe build out $50,000 worth or $100,000 worth of that product. And if you want to get into dividend investing, once you have that base, then you could maybe pick 10 or 15 or 20 dividend stocks that you like, again, dividend like companies that produce products that you use on a daily basis, and then just kind of invest money, right? So you could either say you have $5,000 to invest, you could either pick 10 stocks and then invest 500 into each of them, or you do regularly, $1,000 every so often per one, and then just rotate through those, and then just go ABC and just equal weight. That's one method to do it. Or you could, if you have certain companies that you really like, then you maybe overweight them a little bit. So that's my recommendation, because I think starting now, if you start out with just dividend stocks, you're really limiting your exposure. Like you're not as well diversified. Sure, you could do really well, but there's that risk. And we probably learned the hard way. And we got lucky that, we were able to pull off and not sell ING Direct and Manulife, but some people can. And the advice I want to give people is that, again, your ego is not your amigo, and it's easy to talk about investing when it's not your money. I did in high school. I did like paper trading. There's like online where you get $1 million and you could just like buy these stocks. That's easy when it's not your hard-earned money. But when you're investing with your hard-earned money, and it's just a different psychology. And investing, I think it's majority psychology, right? It's about how do you react when the market goes down 3%, 5%, 10%. What happens if it goes up 10%, 15%, 20%? Some people say, "Oh, I'm going to sell my winner and then buy value stocks." But if you keep selling your winners, you're never going to get these multi-bagger investments. So it's kind of like which side do you want to do? So again, it's a personal decision. You need to figure out on your own. And I think one thing that I also learned is on Twitter and online community, there's a lot of debates about, if you're investing, you're stupid. Like, why would you do dividends? Or, it's index or nothing. Or, oh, you're doing Bitcoin. Like, that's just silly, or whatever, right? There's always people trying to put down other people's investing ideas and theories and stuff like that. But I think end of the day, the good thing is somebody's investing instead of hiding money under their mattress. That's one. Two is I recently heard an analogy kind of similar to investing. And I can't remember where I heard it from, but it's kind of like asking people, what's your favorite food? Some people like Japanese, some people like Italian, some people like Chinese or Indian. That's similar to investing, right? Like there are people that real estate investing over stock investing and vice versa. And even if you like Japanese, it doesn't mean you should eat Japanese. You want to eat Japanese every single day for the rest of your life. You kind of want to switch it up a little bit. right? So that's the same thing as investing. You might start off with dividend, and then you might, like us, go into index a little bit, or vice versa.
Mm-hmm.
So I think it's not just one way to do things. Again, it goes back to your what's your personal finance goals, right? What are you trying to achieve? And use those goals to work backwards to your investment strategies. I think that's very important.
Yeah, no, that's a great response, and we really value that. I mean, that makes a lot of sense. That there's really no right answer. There's no single one right way to do it. Everyone can achieve their financial goals in a various different variety of ways, and really risk tolerances, ability to take risk. It all comes into play, and it's really hard for one investor to maybe dip their feet into high growth stocks, whereas someone else, it might be challenging to go into the dividend route and go that way. But a nice balanced approach is usually what most people kind of come down to, and I think that really makes a lot of sense. So yeah, that's a really great response, and we really appreciate and value your time today. Before we wrap up, is there anything else that you'd like to add or leave our listeners with?
No, I think the final thing is we're always learning. Just because we've been doing this for over a decade doesn't mean we know everything.
Yeah.
I certainly don't. I'm still learning, and don't be afraid of admitting your mistakes. I think learning from your mistakes so you don't keep making them. That's a really big. The same thing with life, right? Like just
that's right.
Learn from your mistakes, and the other thing is it's okay to have disagreements with other people, but let's have educated discussion and not get into personal attacks. And it's unfortunate because with online interaction, we just get into very heated debates, and people start throwing names and things like that. That's the adults, and that's the educational here, right? It's okay to disagree. There's nothing wrong with it, and maybe you learn a thing or two from this disagreement. And
definitely.
Don't just be like, oh, I disagree with these people, therefore I'm never going to talk to them again. I don't think that's how we should do things in life.
Yeah, definitely being constructive and collaborative and learning is always the key in investing. And I've always believed that letting down one's ego is crucial. Humility in investing, learning different styles. It's really one of the best ways I find to learn about new investments, learn about different strategies, and I think it's a great way to build wealth that way. Is maintaining a constructive outlook and always being willing to learn. So that's great. Thanks so much, Bob. On behalf of Michael and me, I just want to thank you again for joining us today. We really appreciate you sharing your story and insights. And then finally, for our listeners who'd like to learn more, where can they find you online or follow your work?
Sure. So I blog on Tawcan.com. So that's TAWCAN. It's a name I made up, stands for Taiwanese Canadian. So I've been blogging on there for over 11 years, and then recently started a podcast with Nelson, and it's called DIY Wealth Canada. So you can find the podcast on Spotify and other podcast platforms. And then if you want to find me on social, again, Tawcan is a name I invented, so I'm on Twitter or X under the handle Tawcan, Instagram, same thing. So find me there.
Nice. That's great. Okay. Well, thanks again for joining us today. That's all that we have for today. We hope you enjoyed this episode of our podcast and learned something new about the Canadian and US markets. If you want access to more exclusive content and insights, don't forget to visit our website at 5iresearch.ca and sign up for a free trial if you haven't already. You can find the link in the show notes below. And if you like this episode, please give us a thumbs up and subscribe to our channel for more updates. Thank you for listening, and we'll see you next time. Thanks again, Bob.
3, 2, 1.